I used to.
Okay, I took this out of the book, Chart School and Level 2, and I put it all together the best I can. And so managing your portfolio, the IBD method. So what we're going to cover is the number of stocks to own, initial position size, establishing positions, force feed method, your routine, money management tips, and examples. So number of stocks to own. To maximize results, concentration, not diversification, when using the CAN-SLIM method. So here they're giving an example, and then I'm going to use $100,000 for an example. So even over 5 million, you should own over 70. Now here's one thing. So say your 100,000 portfolio, you say 5 to 6. When you're layering in and out, and like you're getting rid of your loser and going into your winners, you may end up with more, but your goal is to get back down to this area. So you may not you may have 7 or 8 or 9 or 10 at times, but you should be working towards getting rid of the ones that aren't performing. So your initial position size is going to be 20,000 if you have 5 to 6. So if you have a 100,000 portfolio, your position size is 20. And if you start doing that, that's going to take you back to that, because your winners, you're going to want to have most of your money. Max loss per position using 8% stop loss rule is $2,800. That's why you're spreading it out, which move your portfolio down no more than 3.5%. Because one of your goals is how much am I moving the portfolio up or down. You never want to over damage your portfolio. Try to never hit your total portfolio down on a single trade more than 5%. So that 100,000 we're saying never lose over $5,000 on one trade is what we're trying to do. So even by doing this, on a major dive of the 20K original position, your portfolio can only be damaged by 20% if a stock went to zero. With CAN-SLIM, you'll be out way before then. If you're holding it where you lose one position to zero, I mean, you just really missed the boat. So that's why you got to diversify at least that much. So using margin. With margin, you can increase each position to a max of 35,000. This makes a max of 28% of the portfolio per position. Use margin only in a strong uptrend. On true leaders, you have a large profit in. So this is going to be one that you've held for a while. It's maybe through a 1 or 2, might be through a first stage base, and you've got a good cushion in it. And you went ahead and added at the 50-day or added at the 10-week. Beware of volatility. Only trade full positions in 20 million or more market cap stocks. So don't make sure it's not a small cap stock. Not for beginners. Don't do this if you're not familiar with what you're doing at all. Make sure you have your rules, and will sell early, not late on a move down. Not sure what to do? Get off margin. You don't want margin calls. Establishing the position. First buy off of a base pivot should be 50% of your position size. If you're not going to do that, you're playing in stuff you shouldn't even be messing with. Because if you're not willing to commit to your position size, why are you buying that stock? Why are you wasting time on it? That's the way I look at it. So 10K or your 20K if you had the 100,000. Second buy, stock up 2 to 2.5% from buy point. You added at this 30% at this point. So that would be another 6K. So now you'd be 16K. A third and final buy is no more than 5%. So it's up the rest. You add your other 20%. Now you're at your full position. So you try to layer in. Sometimes you have to layer in really fast. Sometimes the stocks off that first base will pull back. You get to do your second one right after that pullback, not necessarily on the pullback when it comes back through there. So you're adding on the way up. Always average up, not down. Don't chase the stock past the 5% pivot point. Every first purchase is an equal dollar amount. Makes you really commit or move on. That's what I'm talking about on that first buy. You need to be half of your position. Because if you're buying stuff that's 5% position in that, you're just really wasting time. Each add-on buy is smaller. Watch your average dollar cost not to get in too high. Stocks gets hit on a news event, just in case that would happen. So you're averaging up in price, but you're not wanting to get your dollar cost average higher than your initial. Helps you hold through normal corrections if your dollar cost average is good. Follow-up or add-on buy points are when a second base forms, pull back to 10-week average line, 3-4 weeks tight on a previous broke-out stock. So there's where you might start. And when I say using margin, So you got your 100,000 portfolio, you've got a winner, and you want to add to it on one of these. This is where you may not necessarily be on margin, but your percentage of that stock in your portfolio exceeds that 20,000. That's what I call being on margin in that stock, even if you're not borrowing on margin, because you're actually more extended in that stock. And that's not a problem if it's moving up and you're adding on these bases. Write down 4 things. Your profit exit point, so that you know where 20% on a base point breakout, not your average cost. So in other words, write down what the base is and where the 20% is. 8% loss point from buy point. I use and calculate personally a 4% and a 7% loss from my purchase price on everything I buy. I write it down when I buy it. When I see stuff hitting that, I'm looking at it real hard. It's better to be getting out at 4% than it is at 7%. Position size by percent of portfolio. 20K equals 100% position of a 10K. So you want to, I write down my position size. How much percent is this? So a 10K, I would consider a 50% position for that position. And then if I add the 6K to it, you know, if you're starting at 10 and you add 6K to it, now you're at like 70%. Reason for purchase, the base and the story, or the reason at time of purchase. If you write these down, you look back later on, you go, what the heck was I thinking? And you, as you do this over time, it's going to change how you trade, because you're going to think, oh yeah, remember that one where I, you know, already did well, but you know, the ones you blew it on, you say, yeah, and it makes you commit to what you're doing. Force feed method. Best stock should always be your largest position. Shift your money from your losers to your winners. This is how you get down from that 6 to 10 number back to the 5. Make ads on buys at the 50-day moving average and at a second stage buy point. Always add fewer shares than you own. Follow your rules. Be able to act fast. Don't over-concentrate in one industry group. So there's something to be careful of. Since you're only going to own 5 or 6, make sure they're not all in one industry group. You can have a couple of them in there, but make sure you're spread out a little bit. Know what quarter of the game you're in. You know, you got to keep track of where the market's at. So routine, review the general market daily, keep your watch list current, include leaders you missed so you can catch them on the next round, keep folders of buys and sells to analyze, know each stock well, its personality, story, and trading history, use daily charts and weekly charts. Sell if sell rule is triggered. Know your own weakness. That's probably the biggest one right there. Don't try holding them if they're going down. Money management tips. Use the 8-week hold rule. 20% in 3 weeks, hold for 8 weeks. So if you got one that goes up, you know, the 20% in 3 weeks, hold it for the minimum of 8 weeks, unless it comes across some major selling or something. Set price targets. You have to set targets. You think different with a cushion in a position. When you do have a cushion, you think a lot different when you don't. When under pressure, review your reason for purchasing the stock, the base you bought it in, and its sector. So that's where writing it down when you bought it. If you don't have a good convincing reason, you'd be looking at that thinking, well, gosh, you know, maybe I shouldn't be holding this. And then remember the 4 questions. Has my stock broke the 10-week or 50-day line? Is my stock gapping down? Is my stock moving down in heavy volume? Has the market direction changed in a negative way? 3 yeses of 4, you should probably sell the stock. So this is going to help you to manage that portfolio. And you know, those are good questions. I don't think we brought those up for a while. And that's all I had on that. So it isn't really real complicated. Anybody got any questions?